Hello, and a very warm welcome to our latest WOA webinar, Digital Negotiable Instruments, and finding out all about them and whether or not and where they might fit with open account trade finance. Negotiable instruments are going digital. Following the release of the model law for electronic transferable records, MLETR, by UNCITRAL, a number of jurisdictions have been working on adapting their laws to take advantage of this. And it's a big initiative. It's backed by the G7, WTO, ICC, ITFA. The MLETR is perhaps going to be a real game changer for firms who are active in trade, logistics, and in trade finance. So during this session, we'll be sharing the latest progress on the policy side, as well as demonstrating how technology facilitates MLETR adoption. We'll look at some recent use cases that can be shared by the panel. And we'll also think about how this might all affect traditional RF world too. So I'm absolutely delighted to introduce some really excellent speakers who are all expert in this area, well-versed and well-knowledge, who can share their knowledge and experience with you. So first of all, Andre Kasterman, founder of Kasterman Advisory, and who is an expert advisor for the World of Open Account. Andre, welcome.
Great to be here, John. Thanks.
Thank you. And next, Gunnar Collin, Head of Sales and Marketing at Negotiable. Gunnar, really the technology whiz kid on this particular exercise. Gunnar, very welcome, big welcome to you too.
Thank you very much. Very happy to be here.
Thank you. Richard Hawkins, the CEO of Atlantic Risk Management and also a steering panel member of WOA. Richard has a huge experience in the area of, well, as his company says, risk management. So Richard, a big warm welcome to you too.
Thanks, John. Great to be here.
Thank you. And last and not least at all, John Boren, Director, Trade Innovation Solutions Development and Lloyds Bank Commercial Banking. John, it's a real pleasure to welcome you to the panel.
Thanks, John. Thanks for having me.
Okay, that's great. So where are we? I think where to start. Let's look at what's the background, the history, development of trade solutions, and where has MLETR come from? What's its purpose? Why is it here? Andre, perhaps I could pass that question to you.
Yes, let's give some context to this. Indeed, trade finance is still relying very much on paper documentation for various instruments. And basically, there were various attempts over the last almost 3 decades, starting with, Bolero in '97, which was an industry initiative back then, to digitize trade flows. But actually, the real issue is not a technological issue. It's a policy issue, a legal issue. The laws, the national laws have to be changed to enable the market, to facilitate the market to move from paper to digital. And this is what the United Nations basically have worked on some years ago. And in 2017, they released the model law. That's a reference text enabling jurisdictions to align their national laws to electronic transferable records, as they call it. So they have been very generic and focused on how can we actually digitize title documents in logistics, bill of lading, in banking, and corporate market, bill of exchange, promissory notes, and other instruments. There are a few others we can talk about. So 2017 was really a key milestone for the industry on the non-commercial side, the institutional side, to say, hey, we have now a reference text we can use to change our national laws, and Bahrain, Singapore, Abu Dhabi global market as the three initial jurisdictions that made the effort basically to change their laws, to align their laws with this model law. This model law, you will hear us talking about MLETR, model law for electronic transferable records. So that's a key abbreviation to remember for the next hour. Now, if we go closer to 2023, in 2019, the industry also triggered the revision of the 1882 Bill of Exchange Act, so that English law could also take advantage and align with the MLETR. And this is a development most of us have been involved in on the UK side, but it's not just a UK project. It's really a global policy project, because it's changing the English law to electronic transferable records and enabling paperless documents and instruments will basically benefit the whole world, as the English law is used for the majority of international trade flows. So here we are, 2023, with the UK finalizing the work around MLETR adoption. The Electronic Trade Documents Bill is being revised and getting to an approval status within the UK Parliament, and will be transformed into the Electronic Trade Document Act in a couple of weeks or months. The same is happening in France, where the French market is also very actively, it's actually the #1 trade priority at this stage on the French market, on the policy side at least, making sure that the French law also caters for MLETR and enables electronic negotiable instruments. So, and Germany is also doing the same. But definitely we can expect great news this year on the UK side and the French side. This is also happening thanks to support from the WTO, but in particular from the G7, because believe me or not, the G7 included trade digitization as a priority in 2021. So you see, you have a lot of big stakeholders behind this. So it's a very promising change in trade, and that is unlocking digital trade. So policy change first, and then using digital tools to basically help the banks fund more corporates. And we're going to hear about John here, of course, on the business side, what this offers to financial institutions.
Excellent. Well, thank you for that introduction, Andre. I'd also just like to add again to our audience and remind our audience that the panel has kindly agreed that if you have questions, they'll be delighted to try to address them for you. Of course, if the question relates to the topic as we're speaking about, we'll try and deal with it at that moment. If, of course, the question is something which is more standalone, we'll look to make some time for that at the end. But that gives us a really good introduction into the background and where this has come from, and it's quite clear that there's a real, what we would call a head of steam behind it. I mean, it has some very powerful backers, and although obviously in terms of implementation it's relatively early days yet in terms of going through the processes in the UK and France, I'm sure there are going to be many countries that are looking at the implementation of this very, very closely. And as you say, you know, this is the legal framework that we've been talking about so far, and the political motivation for this to take place. But of course, if it's going to happen, it's going to take some technology to make that work. And I think what I'd like to do now is pass over to Gunnar and say, look, you know, perhaps Gunnar, you can take a look at the technology that's being used here, or what it's going to be used, and what it will enable, and what it'll be able to do new, what it'll be able to do better than we can do at the moment.
Yes, thank you. I'll try to explain as well as I can. But to start off, I actually think that the MLETR is a very interesting piece of suggestion, if I might call it that, because actually what it does, it gives the framework for everyone sort of to continue using the laws that are already in place, the business practices, the IT systems, everything that people are using already. And I think that is a major advantage in this whole context, because what we've seen so far is that the way of solving the problem of digitization has always been centered around sort of gather a group of interested parties and create something different, i.e. a platform with its own sort of set of rules, with its own sort of membership and way of doing things, and that has been somewhat successful in some areas. But I think what we really are getting now with this overall sort of suggested legislation is that everyone can continue with whatever they have today, and they can sort of rely on again any statutory law that is already in place. So this is very interesting, and I think it will unlock so many possibilities going forward. So I'm very optimistic, and I never thought that this was actually going to happen during my lifetime. So, but that's just a personal note. Coming back to be a little bit more specific on technology. So actually, what the MLETR says is that you shouldn't deny anything legal effect solely on the ground that it is in electronic form. So actually what that means is that whatever sort of digital or technical thing that you're going to use going forward has to be in accordance with the, for example, the Bill of Exchange Act in the UK from 1882. So for any technology provider, you need to go through and see what are the requirements. And this is really where we are coming from as a company, because we've been very engaged in sort of creating solutions for managing digital data, especially in the space of archiving, right? So we can all understand that sort of dealing with physical documents, we can all visualize what that means from an archiving perspective. But if you have intangible data, it becomes a little bit more complicated, but you still have to sort of do everything that you are required to do. So you need to be really clever, and you need to know what you're doing. And this is really our space. So when we started to develop our solution, the target or the goal was actually to create something that would fulfill the requirements from the Swedish debt law from 1936, okay? And that's a very similar piece of legislation to the Bill of Exchange Act. So we actually read the Swedish debt law back and forth, front and end, and we read everything. And then we built the components that are required to actually create something that is digital and actually does what is required. And what is required then? So first of all, I think it's very important to remember that you basically need to have something that is conceptually as a document, right? So having data points sitting in a system doesn't do the trick. You need to conceptually have something that is a document. And whatever you create, it needs to be in writing. So this in writing needs to sit conceptually in a document. Very important, because otherwise it wouldn't sort of do what would be envisioned for anyone sort of looking at a negotiable instrument or a document or title. But it doesn't stop there, because if that would have been the only requirement, we could use PDFs already now, and we could sort of go on and do things. But that doesn't sort of fulfill all the requirements. You also need to be able to sign it. And as we know today, there are very good electronic signature services available in all places and in many shapes and forms. So you need to be able to add an electronic signature or an electronic seal for that matter. Additionally, you need to cater for the provision on original. So when you are in the digital space, you need to be able to know if you have the original or not. And you also need to cater for control. So it's not only sort of necessary to have sort of a digital thing that you know you have the original, you also need to be able to control it. And when I say control, what I mean is that you need to be able to possess it, you need to be able to continue writing on it, you need to be able to endorse it, and you need to be able to send it to someone else. And when I talk about send to someone else, this is the concept of being freely transferable. So in the paper world, we know I can send anything to John in a paper form, and John will know exactly what he gets, and he can read it, and he can store it, and he can so on send it. The complication comes in when you deal in the digital space. So you actually need to create something that is digital but still freely transferable. The only small caveat to this, being in the digital space, there are actually two requirements. Someone needs to have a computer and access to the internet, but we think that those are quite reasonable requirements if you do it digitally, right? But apart from that, with our solutions, you don't need anything else. You don't need to buy a system. You don't need to sign anything. You don't need to pay any fees. You don't need to sign up. You don't need to share your data, and you don't need to sign a rule book. So this is very, very important, that it needs to be freely transferable. Additionally, there are a few other things that you need to cater for. You need to have a mechanism for change of medium, and you need to provide sort of a reliable system for verification. So once these electronic records sort of travels between parties, they need to be able to verify that they actually have the latest version of the file, or if they have the original, and so forth. So from a technical point of view, these are all the things that we solved because we actually did our homework really, really thoroughly, and this is what our solution can do. If you allow me, can I add a few things to this? Because not only can you then move from the paper world and go into the digital space and actually replicate sort of something that is functioning and working in sort of in the tangible world, you can move into the digital space. But when you do that, you can actually do additional things that you cannot do in the physical world. And some of those things that we have actually added to our technical solution is, first of all, that when you create the record will also contain its full audit trail. So it's very easy for anyone coming in contact with our type of documents to make sure that they can understand everything that has happened to it. We can also make them basically totally fraud safe. Because we know in the paper world, I mean, there are methods of sort of manipulating and changing. In the digital space, it's virtually impossible if you use certain technologies. So this is all very good. Additionally, and this comes sort of with the fact that we've been quite true to the concept of the document. So one challenge that is sort of faced by many parties today is that how do I actually store and manage my data? So do I know where my data resides? So with our solution, again, sort of all the business data and personal data for that matter actually sits in the document, although it being electronic, but you will never sort of risk that sort of your data ends up in somewhere where you don't want it to be, or it's being shared by someone by mistake in some place. So this is also a very good feature. Two other things, then I will stop. Mm-hmm. And the two other things is that we're also sort of using old technology. So we are very true to the concept of a PDF. So you can create a PDF on your computer, and you can use our technology to turn this PDF into a single original. Okay, so this is very powerful because then you will get the document that you can recognize and that everyone can recognize, and you can read it. You will be very familiar with that. But since we're working with technology here, you can also add to the document specific digital standards. Okay, so you can have something that a man or a person can read, but you can also have something that your machines can read. So basically with our solution, it's not only possible sort of to create sort of the concept of the document and everything else, you can actually have something that is basically a digital container that you can send to anyone. and that anyone can actually also digitally consume the content without having to integrate through APIs and things. Yes, so this is the technology, and as you can appreciate, you can get the best of the old world and the new world, and you can still keep your laws and processes and systems and everything. And so we think this is quite exciting. Thank you.
Okay, thank you so much, Gunnar. Let me try and summarize that for myself. I mean, I think you're saying that one of the benefits of this whole thing is that it's evolution rather than revolution. It's developing, and in some ways that's based on the idea of maintaining this concept of a document being something in writing. So the signability, the controllability are important, that you can transfer it even if you are changing the medium to getting it from one place to another, and it's verifiable. I think that's the important thing as well, isn't it? The addition of the audit trail, which hopefully has benefits in terms of the veracity of the trail and the documentation itself. So the technology is here, I think, actually facilitating rather than driving is a good way of putting it, I hope. So, okay, well, if I've got that right, then that's great. It'd be really good to perhaps hear of a real world example of where this type of technology is being put into practice. So if I could bring in John here, please. And John, perhaps you could talk us through your reference case and what your experiences have been.
Yeah, I can do that, John. I'll talk you through a case that we completed as part of a pilot that we were doing with Negotiable and IPFA last year around digital promissory notes. So we've been working probably for close to 3 years on paperless trade, as we call it, looking at ways to remove paper from our documentary trade processes. And the initial steps we went to with Negotiable, we actually worked on a POC with them a couple of years ago, looking at digitizing guarantees. So that was the first product we looked at with a UK government body. The POC was a success. We were able to digitize guarantees and standby LCs. But while we really like the technology, and as Gunnar's just explained, effectively the trace original system creates a digital asset that has all of the same criteria that a piece of paper would have. You're able to control it, you're able to write on it if you have control of it, possess it, destroy it if you're the controller of that piece of paper. But what we found for guarantees, because I would say the majority, vast majority of guarantees subject to English law, there's no kind of requirement to hold the original in most cases now. In the past, there were many types of bonds where you needed to present the bond with a claim or present the bond at cancellation or for assignment. We don't tend to see that as much now. So we were very interested, but we thought there were better use cases for this. And these are around the documents I think that Andres mentioned earlier. So bills of lading, promissory notes, and bills of exchange. I think the next step in our journey was probably around 18 months ago, when IPFA launched the Digital Negotiable Instruments Initiative, and Lloyd's was one of the people that joined at the very beginning on the DNI. And as soon as we joined, we started looking for use cases that we could employ using effectively this contractual framework ahead of any common law change in English law, to basically recreate what we call an electronic payment undertaking, or EPU, which is the contractual functional equivalent of a promissory note or a bill of exchange under the Bills of Exchange Act. So in Lloyd's, we looked at a number of different use cases. We were focusing on those financial negotiable instruments such as bills of exchange, promissory notes. And we use those instruments across a number of documentary trade products. So we will have drafts in letters of credit. We will have promissory notes or bills of exchange in documentary collections. And we also do standalone promissory notes, bills of exchange in forfeiting or reverse forfeiting structures. So we had a look at all of the structures we had, and we ended up focusing in on promissory notes and discounting of promissory notes in a kind of reverse forfeiting structure where we're working on behalf of the buyer. And there was a couple of reasons why we did that. One was the structure was very simple for a test case. So we were the only bank involved in the transactions. They were purely domestic transactions. So we were dealing with all parties domiciled in the UK, and the transaction subject to English law, which made things simple to begin with. And the documentation requirements for these transactions were fairly simple as well. We were only dealing with the financial negotiable instrument, not supporting documents such as bills of lading or other certificates, invoices, etc. So that was one of the reasons why we did it. The other reason was the fact that there were tangible benefits for our clients to focus on this. So in the paper world for these processes, there are a number of different use cases that banks use these for, but one example, and the one that we focused in on for the pilot, was in the house building sector. We have a number of clients that use promissory notes to purchase land from landowners on deferred terms. So they may agree to pay for the land in 12, 18, 24 months in accordance with the promissory note that they sign, but we purchase that promissory note from the land seller so that funds are available at completion for the land seller. So they're effectively getting their funds up front. Now, what we found is that the process itself for the documentation can take some time, normally around a week to get all of the documents together, because we were having an original promissory note in paper form traveling around the parties to allow for it to be signed by the buyer initially, endorsed by the seller, and then all of those documents have to come into the bank's possession before we can actually make the purchase. So utilising the Digital Negotiable Instruments Initiative and Trace Original Anisio system, we were able to digitise that process, and effectively we took on the logistics of creating the draft promissory note for our client. We allowed them to sign that promissory note electronically and forward us all supporting documentation electronically as well. So it's effectively the same as in the paper world of them coming into our office to sign, because we maintained our hand on the promissory note at all times. Effectively, it was in our possession. And then once that was created, we were able to effect the transfer of the promissory note over to the seller's legal possession, which allowed for delivery under the law. And then at the point of purchase for us, we would transfer that digital asset back into our possession, and that was our security. So all in all, I think the documentation process that we've we did the first transaction in August. We've done more transactions since then, all in that house building sector, and we've probably reduced the time, I think, to around 24 hours. The longest one's taken just shy of 48 hours compared to a week to get the documentation in place. So that was the use case we looked at, and we concentrated on promissory notes over bills of exchange format purely because they were simpler. We only needed the buyer to sign rather than the seller to draw the instrument, but equally we're open to those structures. As we said, we've done the transaction in August. There was quite a lot of press. It was the first transaction under the Digital Negotiable Instruments Initiative, and the first, I say prom note in inverted commas because it was an EPU, but the first prom note purchase that was done by a UK bank. So what we're looking to do now is move forward and look at more complex structures. We've been talking to a lot of banks and other parties, fintechs, etc., who are interested in doing a kind of four-corner model transaction where there'd be another financial institution involved, whether that be a primary transaction where one party took on an avalisation role, so a guaranteeing of the bill of exchange prom note, and one took on the discounting role, or whether that's a secondary transaction where a financial institution buys a transaction that's been done by another bank. But we've seen a lot of interest from a number of parties, and you may have seen that there was another press release recently that the first EPU that was done in a digital bill of exchange format was done by another IPFA member, Merkel, who are doing microfinancing in the SME space. So, and we were heavily involved in that as well, working with them to kind of knowledge share on how we did the promissory note.
Excellent. Okay, well, thank you for that. My immediate reaction is really a question for you based on that early experiences. I mean, do you feel that doing it in this new fashion is a question? Is it replicating the process that you would have done on an original paper-based system, simply making it electronic, or is it providing any opportunity for simplification, rationalization, or is it in fact the other way going, sort of giving greater diversity or complication?
So I think initially, and the transactions we've initially completed, they are digitization of current practices that are, and transaction flows that are done on paper at the moment. And we've seen those efficiency benefits and gains from doing that digitally. We are actively looking for transactions that are not current paper flows. And I think, as I say, we focused on a structure that was, you know, it's fairly long tenor. And transactions that can be done in the paper world, because that kind of week to collate the documents when you're talking about a year or 18 months tenor is not huge. But there are other flows out there for, say, shipment of goods, where we're talking around tenor of, say, 45 days, 30 days, where if it took a week to pass these documents around, it actually really cuts into the discount period. So yeah, so those flows probably aren't don't actually end up being financed. So we do think there are flows out there that, you know, like there are actually the trade finance gap, where we can actually, as a bank and other banks and other FI fintechs are out there doing it already, as I mentioned with Merkle, you know, they're cutting that trade finance gap by using these digital instruments.
Excellent. Okay, thank you. So yeah, it's a question really of early steps and sort of learning through experience. Right. Okay. Well, thank you very much for that. I suppose what I wanted to do was to try and broaden the conversation in a sense and say, you know, well, okay, we're looking at this new methodology, but are there any alternatives to this? You know, what are the risks? What are the benefits of taking these new approaches? And I thought perhaps Richard, you'd be really well placed to perhaps have a view on this, or some questions in this area, things that we want to think about.
Yeah, thank you. I think it's interesting. It shows we are at early stages, but I think the world is moving quite quickly. I think the interesting solution, the gap, the trade finance gap, I think is where the digitalization of these instruments is really going to have the most profound and potentially far-reaching effect. And that is the financing of trade, the financing of the shipment of goods. And to do that, obviously, we need to have a very, very efficient system in order that can happen. And I can see that happening quite quickly. And my role in this, in terms of looking at the risks involved, does the digitalization of these transactions, does it eliminate risk? And the answer is no, but it does significantly or potentially enhance or reduce the level of risk involved in trade finance transactions. Because what it does do, it increases the willingness to pay, but it doesn't necessarily do anything in relation to the ability to pay. By increasing the willingness to pay, then ultimately what it does in terms of opening up the trade finance gap is it encourages more financial institutions to become involved in financing trade that hitherto they are less inclined to finance, because now there is a greater level of security within the transaction. So I think that in terms of what are the alternatives, well, the alternatives is to do nothing and stay the same and go nowhere near to fulfilling that trade gap. The opportunity here is both to fulfill the trade gap, but also to improve the process under which finance is delivered to businesses that need it. And accepting that, you won't eliminate all of the risk, but you can potentially significantly change the risk, and therefore encourage a higher level or higher proportion or higher degree of financing into areas that I said hitherto have been ignored or moved away from, or from those sort of financial institutions. So I think that's where the interest comes from my perspective here.
Okay, and in terms of you said you can see that it assists in the willingness to pay, but obviously not in terms of the ability, the credit perspective to pay. What do you think are the sort of the things that people would need to think about if they're introducing such an automation of the process?
End of the day, you still got to look at the end customer and who the obligor are, and what is the risk in the transaction. What this does do is provide some level or potential level of certainty that if the customer has the ability to pay because of the strength of having a signed, fully executed either promissory note or bill of exchange, in terms of you're higher up the food chain in terms of getting paid. The other thing that tends to be significant in dealing with credit risk is the fact that a bill of exchange involves a third party, often the obligor's bank, and defaulting to a trade supplier is very, very different to defaulting to a trade supplier in the eyes of their bank. And that is why a bill of exchange or promissory note that has been fully executed and is legal and binding is more likely to get paid sooner and quicker than somebody that's operating on open account, particularly if that entity that is operating on open account is from a country that is remote from the buyer.
Okay, so again, I think that in terms of the premise at the beginning, do you feel that this there is any application of these principles within the open account world, or do you think this is really something which is going to remain within the ambit of negotiable instruments?
I hope not. The hope is that this sort of democratizes the accessibility of finance for trade transactions that are currently not being accommodated by institutions or not necessarily accommodated by alternative providers. There is some by the fintechs that are providing some levels of finance, but not all of those are done in the most secure and equitable way. So yeah, the opportunity here, and I'm sure that Andre's group is looking at that, the opportunity here is to expand the availability of finance of trade transactions and potentially, of course, enhance existing transactions that are financed on an open account basis, and potentially enhance that in terms of providing higher levels of finance, higher percentages of levels of finance, as opposed to the normal sort of discounting rate of 80–75%. If you have a significant proportion of the trade of an organization run through using a digitalized method of payment, then ultimately the security of those transactions is high, and therefore the advance rate is high. And also, it should mean that the financing is cheaper for the borrower, for the seller.
Okay, we've had a question in from an audience member who's asking for a comment, and this may be from a risk perspective, both for a question for Richard and for Gunnar, that in digitization, what about cyber risk? With digitized documents, what about data breaches and the risks that are associated with that?
I'll let Gunnar have that one.
It's quite a huge question, to be honest, but I try to sort of give my view on it. And I think sort of what we're moving into now, and especially the discussions we are having with the banks, is that now the banks can actually possess a digital asset, right? And that's quite different from sort of possessing a physical bill of exchange, for instance. And I know, and I think we all can agree that, at least from sort of a very intuitive level, we all know what we have to do in sort of protecting our cash or our checks or whatever we have. So there are good routines and ways of doing that. So, and then when we move into the digital space or into the cyber space, I think the good news here is that particularly banks, they are extremely good at cybersecurity, because all banks are are sort of handling extremely sensitive data. So that cannot come out. I mean, there are sort of enormous amounts of security layers protecting the bank's data. And I think when we now sort of again sort of start talking about digital assets, of course these will be protected by the same measurements. And I think, I mean, at least from our point of view, sort of these measurements and controls and what have you is extremely comprehensive. So I think at least my sort of quick answer to this is that sort of if banks deal with these assets, they are very well protected, to say the least. And it's very rigorous, all of this, yes, because it's very sensitive for banks for all type of data.
Okay, thank you. And another question has come in, which I think we could handle now appropriately, and that is again talking about this march of digitalization. We're talking about negotiable instruments so far, but the question here is, what about invoice digitalization? Where are we at the moment, and are there any regulatory bottlenecks preventing that from happening? Do we know? Anybody got a comment on that?
I'd say from a documentary trade perspective, so talking about letters of credit or anything like that, we regularly do see the presentation of, when I say digital or electronic, I'm talking more PDF, not using solutions such as Negotiable, but regularly we see electronic presentations of invoices under those platforms. I'm not aware of anything that any inherent value of an invoice that you get with a bill of exchange or a promissory note, such as the right to payment, or with bill of lading, such as the right to the goods. So we are seeing those documents are a lot easier to digitize compared to the ones we're discussing today.
Yes, okay. So it's a bit of an appetite thing as much as anything. Okay. We've talked in our conversation so far about the sort of where we've got to, and it clearly is in the wider scheme at an early stage. But it's fantastic that we've now got this clear model law and being able to use it in real world applications. And jurisdictions are working on it, as we've heard from Andre, particularly in UK and France, for example. But I would like sort of, in the closing part of our discussion, for us to actually put our sort of our telescopes to the eye and look to the future, and see, how we see the environment developing, the solutions, the applications developing through time, and where we see ourselves using these systems, what the level of application will be, their level of penetration into the markets, etc., in the coming months and years. So perhaps I can go back to Andre right from the beginning. Andre, you talked to us about where we are now. Where do you see this going?
So basically, the blueprint we're going to publish in a couple of days around the D&I initiative suggests that we should focus on digitizing the document first, and offering to the market something electronic, of course, but something that the banks and the market can verify in real time on a continuous basis, because you want to be sure your asset has not vanished, disappeared, attacked by cyber. So the technology enables to do much more once we move from paper to electronic, thanks to the online verification that is enabled, can be automated, and the fact that the technology enables those instruments, bill of exchange, prom notes, bits of lading, warehouse receipts, to be freely transferable. So that means that if John on Lloyd's side decides to use one piece of technology, that means John is not required to get Lloyd's onboarded on all the corporate platforms that are emerging. Certainly in the SME space, there are a lot of corporate platforms enabling SMEs to send indeed promissory notes and bills of exchange to the bank. So there is a interoperability between the two worlds, corporate and bank, and everyone is choosing the application it prefers. Now, once we have these electronic bills of exchange under common law, English common law, potentially indeed also the French Code Civil and so on, so different jurisdictions and international legal schemes, then the whole point is all about looking at how can banks expand supply chain finance, because supply chain finance has been developed really in a proprietary way. with focusing on large buyers, retail industries, focusing on proprietary legal schemes that the buyers have to approve, that are subject to accounting treatment discussions. And why can't we just indeed use the bill of exchange as a standard legal framework, first of all, to basically do what we do on supply chain finance, but to open up the market and not being limited to large buyers, basically, and proprietary schemes, because the bill of exchange is accepted in the market. There's ample liquidity for that, and it's highly standardized thanks to the English common law. And it's now becoming interoperable with technology like the one Enigio is offering, and the vendors that are implementing that technology on the corporate side and on the banking side. So the real opportunities for banks to expand supply chain finance to and make supply chain finance more accessible. Richard said democratize. I like this word. Democratizing is an important way to offer the same kind of service to many more people, and go down market to mid-cap buyers and the SME suppliers, which is what indeed the Trade River, the Mercor of this world are doing, and also looking at indeed using the English common law for that purpose. So boosting supply chain finance on the back of the English common law, the French Code Civil for those jurisdictions that prefer the French or German law, is really the opportunity for funders of any size, large banks like Lloyd's or smaller originators.
Thank you. And that idea of broadening it is the usage and acceptability, sort of the benefits of scale that come from that, and cost that will arise from that, I think are pretty clear. We've been asked the question though, how do we get buyers to accept, for example, e-bills? How do we, create the preparedness for them to do that? I think part of the answer you were saying is interoperability, so it becomes easy to do. But is there something cultural as well that we need to address?
Yeah, I think that was my key question to John recently. How far would UK buyers be willing to accept the bills of exchange produced or issued by emerging market suppliers, by their own suppliers? So we still depend indeed on the willingness of the buyer to accept. But if we approach the buyers with an industry scheme like the electronic bill of exchange, rather than a bank proprietary supply chain finance scheme with heavy documentation that the buyer needs to review, I think the standardization of the practice will help. But I would refer to John for this as the banker in front of the large buyers.
Mm-hmm. So I would say, as we talked, the transaction I've been talking to you about are ones where the buyers have already been willing to accept promissory notes, so that in those situations it was fairly easy. And when we're coming at it from a facility that's kind of that reverse forfeiting type of facility where we're acting on behalf of the buyer, I think it's easier than working from the other way. But I'm guessing, I suppose, one of the benefits to buyers would be the fact that in certain kind of lower level structures, that the seller may be able to offer better or extended payment terms to buyers if they're able to obtain finance from either their bank or the buyer's bank, depending on the structure. And I think with some of these primary structures as well, I mean, we've seen there are fintechs in the market that finance suppliers, in emerging markets, and they may not be willing to take risk on kind of mid-tier buyers, say in the UK. But if we use this bill of exchange structure, and a bank like Lloyd's or another bank that they are willing to take risk on is willing to avalize that instrument, that could also help with the financing of these instruments.
So do you yourself, John, see that there's a real opportunity for expansion here, or do you see it still remaining within pretty much the existing fields?
So our view is that we do think this will increase. At the moment we see it in only really niche. In the paper world, we only see it in niche use cases, but we do think that this will increase, and I think that's in line with what the Law Commission found in their white paper, that their view is that this is going to increase. use of digital bills of exchange and digital promissory notes. So that's our expectation, yes.
Okay. Now, I'm sorry, I spoke over somebody there who was about to make a comment.
Yeah, and just adding to the fact as to why buyers might wish suppliers to operate on this, because it may create an availability of finance that they wouldn't have if they were just trading on open accounts. So it is potentially looking after the supplier if the supplier is an important part of the supply chain.
Mm-hmm. Sorry, go on.
There is also another element for those banks, but certainly also for supply chain finance platforms like non-bank originators, I would say, like Mercor or TradeRiver, and many others actually in the market, more specifically in the UK than in France actually. They for those who have balance sheet restrictions, the bill of exchange acting as an irrevocable and unconditional payment undertaking is very attractive to institutional investors in the distribution space. So for anyone, including the Citibank of this world or HSBC, that have, whether they have balance sheet capacity or constraints, there is an option to distribute, so sell down those bills of exchange to institutional investors or to other banks through the distribution, and really move into an originate and distribute model. So balance sheet capacity on the bank side should not be an issue, just because these institutional investors, they like and they have experience with some of the top banks in buying IPUs, and we can, as an industry, position the bill of exchange as a new form of IPU, unconditional, very important. So we avoid any performance risk here, and I think the key question is indeed the buyer appetite, but it's the same logic as today in supply chain finance schemes. The buyers have to have an appetite to open up supply chain finance to their suppliers. It's just that with the bill of exchange and the electronic bill of exchange, we are basically creating a standard for IPUs in the market that the current schemes do not offer at all. I've always been amazed after 15 years in trade that supply chain finance has never been standardized across banks. And I think there were good reasons for that, because each one is focusing on its own business development in isolation, and banks have been hugely successful with supply chain finance. But now the industry has an opportunity, really, with the bill of exchange, to move to a standardized supply chain finance proposition.
Without the need of expensive platforms.
Yeah, exactly.
Yeah. And again, I think that almost answers the question that has come up from anonymous attending, saying e-bills are still not accepted by ports in many countries, and even if banks can convince the buyer and seller, what can be done to convince regulatory bodies? But I guess it's creating confidence through a standardized system, and actually developing these origination distribution systems that actually work, and people will see it working in practice and that will create the confidence to participate.
I think on the e-bill of lading side as well, I mean, Gunnar might want to mention the work you're doing there, but I mean, one of the reasons we picked the financial negotiable instruments to start with first is there are less parties involved in the chain. Although as a bank, we're not the issuer or the acceptor of these instruments, we're only one party withdrawn from that. So we are able to kind of take on that logistical role for them. I think e-bills of lading, that there are complications around that. There are complications around the multiple number of closed systems that are around. I know Bolero was mentioned earlier, and there are others that are currently issuing e-bills of lading. I think one of the things to mention around the Inegio system, which I think Gunnar touched on, which has been useful for us when we've been looking at the instruments we've been looking at, is that it's not a consortial closed system where you have to get on board the buyer or the seller. Like the fact that the document printer, so the entity that creates the draft, is the only party that needs to have access to the system. So that actually makes it a lot easier to kind of find transactions and get transactions completed, because we're not relying on having to actually sign up all of the corporate clients onto a specific platform in order to trade.
So again, it's a question of adapting to what can be complexity, and one step at a time. I think, you know, use what you can and adapt to what you can effectively.
Yeah,
well, sorry,
just a quick comment on that. So, and I think the question around bills of lading is very relevant, because obviously that's a huge pain point, especially in classic trade. I think it's important to remember that the MLETR is also sort of focusing on solving the problem for bills of lading, right? So being able to move from paper to digital without, as John said, having a platform, because actually what the platforms do is they are keeping the title registry, so the platform will know who is actually having the title at any point in time, and that's just a substitution then for being in possession of the actual bill of lading. So I think to add on to what John said, if the MLETR, which I think will be successful, this would also open up the possibilities of dealing with electronic bills of lading without sort of having to subscribe to a particular title registry as such, or being on a platform. And that will solve the problem for the parties in the chain, because there are so many parties in any trade transaction that sort of needs to be part of the transaction. Yeah.
Yeah, I'd also add to that. I don't think you can expect all of these digital instruments to sort of to move and to be adopted at the same time. So you're going to have different speeds of adoption. And I think that sort of promissory note bill of exchange is likely to be, or has the potential to be adopted quicker than necessarily the digitalized bill of lading, because of the multiple parties involved in that process.
Okay, well, as ever with our webinars, we've whistled through our allotted hour, and really coming to the end of it. And I think for me, just almost that last few sentences there that we've been had, sort of the benefits that we can get: visibility, simplicity, rationalization. I think that you know, improved business process efficiency has to be one of the greatest potential benefits of introducing MLETR, you know, right across the piece, and it will be step by step. So that's my thought, but just some closing thoughts. Andre, what's your final thoughts for the day?
So on the technology side, we need to move to a 21st century mindset for this project. It's enough of closed ecosystems, closed platforms, expensive as well, as Richard said often. We need to mandate technology players to become open. And what MLETR forces us to do on the trade side is to basically use very advanced technologies, but easy to use, but very advanced, to make sure this interoperability at document level is facilitated, so that everyone is using its own software solution and the documents are interoperable. So that's, for me, I think the most important shift in mindset that still needs to occur, because MLETR is now well understood in the market, but still many in the market don't see the opportunity to leverage open banking practices in trade finance, which is why I wrote a blog about it, and will be released in a few days. Excellent.
Well, we'll look forward to seeing that. Gentlemen, John, any last thoughts from yourself?
Just echo what Andre said, really. I think the short term for us is looking at the law change coming in this summer in the UK. That gives us the opportunity to simplify the transaction structures we've already done. But I'm just hoping the EPU transactions we've done and other DNI members have done have proved that this can be done in a digital way, and just hoping to be involved myself and see other people in the industry involved in more of these digital transactions in the coming year.
Excellent, thank you very much. And Richard?
Yeah, no, I'm quite positive about it, John, which you know is unusual for me. So, but no, it's been a good conversation, and it's been a good conversation, and I'm you know excited about the prospects for this. I think it could be an important, it could be a game changer as we go through the next sort of months and years, I think.
Excellent, thank you. And Gunnar, last word from you.
Yeah, thank you. I wanted to tie back to what you said early in this webinar. You talked about evolution, not revolution. So I think this is exactly where we are. So the old classic trade can now finally go digital, which is good. For everyone else that sort of has solved the problem in a different way in the open account space, they can now start to leverage all traditional instruments that are actually quite clever and quite useful because they can now be digital. So it's a win-win, to be a bit cheesy at the end.
Excellent. Well, we all like to end on a win-win, so
Yes.
that's great news. So I just draw it to a close there, and thank you, panel, for an absolutely fascinating conversation. Thank you, audience, too, for participating. We will upload the webinar recording onto our website and YouTube channel. So it just remains for me to thank all of the panel for their participation and thoughts, and wish everybody a wonderful day. Thank you all so very much.
Thank you.
Thank you.
Thank you, John, and the team. Bye-bye.
Thanks, John. Thanks, everybody.